Peace of Mind, where we discuss financial topics of the day and help you attain and sustain your financial peace of mind. My name is Michael and Martin. I'm joined by our host and financial expert, Guy P. Jones, CFP. Guy, since some of our viewers may be tuning in for the first time, why don't you give them a little information about yourself and your practice?
Thanks, Mike, and thank you for tuning in today. Well, I'm a local certified financial planner who's lived in the Houston area for the past 26 years, and I've been in the financial services business for the past 25 years.
And how long have you had your own practice?
Well, in 1998, I completed my studies at the University of St. Thomas here in Houston, and so you might say that I've had my own practice for the past 15 years.
So tell us a little bit about your practice.
Well, I mainly work in the areas of retirement planning and investment management, but I also have developed a particular expertise in tax-free retirement strategies.
That's great. What sort of outcomes do your clients look for?
Well, because I've dealt with a clientele over the past 24 years of primarily conservative individuals, they primarily look for low risk, low volatility, with a high probability of success.
And do you have a particular philosophy for your practice?
Yeah, I do. I've tried to position my practice as the low risk, safe and secure advisor. We primarily have an emphasis on the client's money not going backwards over the next 5, 10, 15 years. And we also feel like it's just as important to educate our clients as it is to manage their money.
And you've talked about this before, that your approach is more than just helping clients invest.
Yep. I try to think of myself, or I do think of myself, as a counselor rather than what I would call a product pusher, okay? Because I've had conservative clients, their primary emphasis is on protection of their principal with modest growth. And so one of the things that I want to emphasize to our viewers is that I really value relationships more than transactions. And what I mean by that is that in establishing relationships with clients, I not only get to know them, but I get to know their spouse, I get to know their children. And then oftentimes, I've even had clients recommend me to their mother and father. So in the same vein that I establish relationships with my clients, I also want to establish that same relationship with you, the viewer.
So you mentioned earlier that you focus on low-risk type investments. Doesn't that normally mean low returns? What would be a reasonable expectation, understanding that you can't guarantee any future results?
Yeah. As an investment advisor, really no one, can guarantee future results. And past results really shouldn't be an indicator of future results either. So bottom line is no one has a crystal ball. But based upon what we've been seeing for our clients in our low risk, low volatility investment platform, a reasonable expectation would probably be in the range of 6 to 7% on average per year over the next, say, 5, 10, 15 years.
So I think that sounds like a reasonable return. Is there a particular type of client that you prefer to work with?
Well, we primarily have worked with retirees and pre-retirees. These people, because of where they are in life and maybe even their age, are primarily conservative in nature. And so if you're looking to have your money, say, aggressively invested, we're probably not the advisor for you.
So obviously you work with individuals. Do you work with businesses as well?
Okay, well, in using my past experiences and past expertise, what I do is I help individuals and businesses create tax-free retirement plans, but I also help them manage their pre-tax retirement plans. And then I also help businesses create what I call executive benefit plans. And these are plans that enable them to recruit, retain, and reward their key employees.
So you work with people and businesses to help develop retirement plans. What if someone is changing jobs and doesn't know how to handle their retirement plan?
Well, I work a lot with people in transition. And what I mean by that is people that are coming either into a new career or people that are leaving a career, either via a job change, a career change, or more importantly, retirement. And so what happens a lot of times as people go through these career changes and then especially, I guess, when they retire, is they leave behind a lot of these 401k plans or retirement plans. And so what results is kind of a hodgepodge of retirement plans that are really not being managed in a very comprehensive, cohesive manner.
And so what do you do in that situation?
Well, I help them bring together those plans, I help them consolidate them into a single managed account, typically an IRA if it's a qualified plan. So I help them bring those together using our low risk, low volatility investment platform.
And so tell us more about the business side.
Well, insofar as businesses are concerned, I work with people in HR roles because they are working with people in transition, either people that are leaving the company or people that are coming into the company. And so quite possibly they need a financial advisor. Also, I work with people in the recruitment industry because they work with people in transition, coming into or leaving a position. And then, of course, I work directly, with people that are changing careers or retiring.
Okay, why don't you tell us something about your practice that's unique?
Well, one of the things that I like to tout about my practice that I feel is unique is the fact that we're able to custodial assets through actually two custodians, Fidelity Investments and Trust Company of America. And so I feel like it's very, very important to give clients a choice. Now, in making that distinction as to maybe which one would be more appropriate, one or the other, Fidelity would be for the person that maybe has a particular stock or security that they want to hold. For instance, Aunt Jean left them the Exxon stock that they can't sell, so they need to hold it in a Fidelity account. Whereas Trust Company of America utilizes institutional money managers.
And so why do you think it's important that clients have a choice?
Well, I think, as a fiduciary, okay, and let me just step back and make the distinction here. A fiduciary standard means that I'm always required to act in the client's best interest, okay? Whereas in dealing with a broker through a brokerage firm, the standard there is that they only have to make sure that the investment is suitable for the client.
That's an interesting point. I thought all investment people were the same. So how are you different?
Well, I'm what's called an investment advisor representative, okay? And I work through a registered investment advisory firm. Consequently, the standard of care that we have to clients is, like I said, a fiduciary standard. We're always required to act in the client's best interest. Brokerage reps, on the other hand, work for brokerage firms, okay? They work for them in an employee-employer capacity. So at the end of the day, they're responsible to their employer, okay? Whereas I'm responsible ultimately to the client.
And so you have to act in your client's best interest.
Absolutely.
And I've heard you make the analogy that it's kind of like the difference between a butcher and a nutritionist.
Yeah. So when you go to a butcher, what is he going to sell you?
Meat.
Meat. So regardless of whether it's beef, pork, lamb, or whatever, at the end of the day, it's going to be meat, regardless of whether meat is actually good for you. But on the other hand, a nutritionist is going to meet with you and ask you about your current diet, ask you about your current health, ask you if you have any health concerns, dietary concerns, and is actually going to come back to you with a plan, a dietary plan that is actually going to be good for you. So in that respect, I'm more like the nutritionist, whereas the brokerage reps are more like the butcher.
So did you ever consider being a broker instead?
Well, I started out my first 2 years in the business with a brokerage firm and quickly found out that that wasn't for me. So it was always very, very important for me to be unbiased and completely independent in terms of my recommendations to clients.
Well, speaking of recommendations, when we come back, we're going to continue our discussion from the past few weeks about how to eliminate income taxes and investment losses from your retirement income. Please stay with us. You're watching Financial Peace of Mind with Guy P. Jones, CFP. Welcome back. You're watching Financial Peace of Mind with our host and financial expert, Guy P. Jones, CFP. Today, we're continuing our discussion from previous weeks on tax-free retirement strategies. Before we do that, Guy, why don't you give our viewers a recap of what we talked about last week and then how it ties into our show this week?
Okay. Well, great. Thanks, Mike, and welcome back. Last week, we talked about a concept called IRA Rescue.
I remember it. I'm sure our viewers are asking themselves, like me, what is an IRA rescue and why do I need one?
Well, basically, it's a way to multiply the amount of your IRA that you ultimately leave to your heirs and make it tax-free at the same time. But, to answer your question, it's not so much whether you need one as it is, why do I want one?
Okay, why do I want one?
We know that I often answer a question with a question. So I'll ask you this question, and I'll ask your viewers this question. So if there's a way you could multiply the amount of your IRA that you leave to your heirs by 2 to 3 times and give you full access to your original IRA, would that be something you'd be interested in hearing more about?
I think I can speak for the viewers and say that they would, because I know I would want to know more about that. So why don't you tell us a bit more?
Okay. So in answer to that, well, what do most people want to do with their IRAs?
I would imagine they either want to spend it or they want to leave it to their heirs.
Exactly. So this works best, this particular strategy, IRA Rescue, works best for the client whose primary objective it is to leave the IRA to their heirs. And so I've done this for several clients, and I'd like to take you through an actual client scenario to illustrate what I'm talking about.
Well, I'm sure our viewers want to know more about this, as I do, but you also said they have full access to their IRA at the same time. So how would that work?
Well, how about I go through the numbers and explain how this works, and I think we can illustrate it best by doing that.
That sounds like a great idea.
Okay. So this particular client was a 66-year-old lady, okay? She had an IRA that was worth $170,000, okay? The client had adequate retirement income, so there was actually no need for the IRA. And I might mention that this particular client has a pension, so she has something that, regrettably, a lot of other people don't. So she wanted to leave this IRA to her 2 children. So we were exploring various options to do that. So I did some analysis, and if the client left the IRA to the children, they would each get about $64,000 each after paying the tax on it. So we went through a study, and if she used the after-tax distribution from the IRA over a period of 10 years, that it would have bought a tax-free death benefit of $463,000, or about $231,000 per child. So if you were one of these children, which would you rather get, the 64 or the 231?
I'm going to ask for the 231 guy, but you said the client used the after-tax distributions from the IRA. So just to be clear for the viewers, you said there's no way to get around paying the tax.
Exactly. Regrettably, the government has set these things up to where they are, I call them tax bombs, tax traps. So yeah, there's no way to get around paying the tax. So it has to be paid one way or the other, either during the client's lifetime or at death if they were to leave the IRA to the children. So it's really up to the children as to what they want to leave. It's really up to the client as to what they want to leave the children. Do they leave them the tax bomb, the IRA, or do they leave them the tax-free death benefit, which is almost 4 times greater?
It's really exceptional. Does the client have to pay the tax, or could the children pay the tax?
That's a great point. The parents could pay the tax, but oftentimes they don't want to, and sometimes, I've gotten some pushback on that. So instead, the children could pay the tax by way of, shall we say, reimbursing the parent in return for the larger tax-free death benefit when the parent passes. So again, let me pose the question to you. Would you pay 10, 15, 20, 25, 30 cents on the dollar, the tax, in return for a 4 times greater tax-free benefit?
Of course I would, but my question is, could you do this with any type of account, or does it have to be just an IRA?
No, it really could be anything. It could be a CD account, anything where the parent would want to use the account to multiply the amount that actually goes to the children or the grandchildren. So let me ask our viewers, how many of you are beneficiaries of your parents' IRAs that they intend to leave you. Which result would you rather have as a beneficiary? The IRA or the 4 times greater tax-free death benefit? Could paying the tax today on your parents' IRA help supplement your retirement later? How's that for a retirement plan?
Those are all great questions, Guy. I'm sure this is going to generate some interesting discussions between parents and children about tax consequences of inheriting an IRA. Is there any other instance where this could be used?
Yeah, another case in point is whenever you reach age 70 and a half and you have either a retirement account or you have an IRA, you're required to do something what's called required minimum distributions, okay? And it's just the IRS's way of making people take something from their IRA instead of perpetually leaving it on a tax-deferred basis and passing it to their heirs.
So the IRS creates a taxing event.
Exactly, exactly. So what could they do with the RMDs instead of just, shall we say, spending them? Okay, they could use the RMDs to purchase a tax-free death benefit for the heirs. The client still has access to their IRA balance in case of an emergency, and they can pass on the remaining IRA balance to the children at death.
I think this is amazing, and they would be all over that. This sounds like a perfect example of having your cake and eating it too.
No doubt, no doubt. Well, the life insurance could actually be used to pay the taxes on the inherited IRA, so you get the full value of the IRA. So it's definitely a win-win for the heirs. They get the full value of the IRA, and they get the tax-free death benefit from the life insurance.
That's incredible, Guy. I never knew something like that was even possible.
Yep.
So what are we going to talk about today?
Well, today we're going to talk about another concept along the same lines. It's called reverse legacy planning. And basically it's just a way for parents to help the children save for their retirement using life insurance instead of a pre-tax retirement plan.
Well, I'm sure our viewers can't wait to hear more about that. Before we do that, we're going to take a short break. When we come back, we're going to be discussing reverse legacy planning. You don't want to miss it. You're watching Financial Peace of Mind with Guy P. Jones, CFP. Welcome back. You're watching Financial Peace of Mind with our host and financial expert, Guy P. Jones, CFP. Today we're talking about a concept called reverse legacy planning. Guy, I've heard of legacy planning for heirs, but I've never heard of reverse legacy planning. Can you explain that?
Yeah, thanks, Mike. And again, thanks to our viewers for tuning back in. Today we're going to talk about a new concept called reverse legacy planning. And I know that sounds odd, doing something in reverse, but so is the concept of doing a reverse mortgage before it was blasted all over the TV and radio. But, of course, that's a concept for another discussion. So all reverse legacy planning is putting life insurance on the parent at the expense of the children. But I think, for our viewers, it's best understood by, maybe going through an example.
I think that's a great idea.
Okay, so let's say, for instance, we have an adult child that's age 35, and that adult child is considering putting $17,500 per year into their 401k, which, by the way, that's the maximum amount that someone under age 50 can put into a 401k.
Okay.
So they contribute this for 25 years, and let's just say hypothetically that it earns a 7% return, okay? Not that that's guaranteed, but hypothetical 7% return. So over that 25 years, that turns into $1.1 million, okay?
Sounds pretty good.
Yep. So when you factor in the top federal tax rate plus any applicable state tax, you could be looking at a tax rate of, say, 48% for our conversation. And so just for simplicity's sake, you apply that 48% tax to that balance, and you wind up with, instead of $1.1 million, you wind up with $615,000 after tax. But let's just say, for instance, that the account didn't earn 7%. Let's just say that it had some bumps along the way, maybe incurred some losses, and he only earned an average rate of return of 3.5%. Okay? Well, that after-tax amount would only be $315,000.
Well, initially this sounds good, that the result is originally $1.1 million for your retirement. I'll take that all day long. However, I'm sure you're going to tell us how reverse legacy planning tops that.
That's exactly right. So, pre-tax retirement plans, if you've been watching our show and you've heard me, they have two problems, okay? And one of them is taxes, which is the main problem, and investment losses, okay? So that's two strikes against any pre-tax retirement plan.
Which you just went through an example in the 401k.
Exactly. So there's no way around the taxes. So we've established that. And there's no guarantee that the account's going to earn 7%. But I can tell you, as I go through these numbers, you'll see how the reverse legacy planning is drastically different. So let's just say that same adult child, age 35, puts that same $17,500, which for our conversation, that's the limit on the 401k. But in actuality, there is no limit. You can put whatever you want, okay?
Into the life insurance.
Into the life insurance. So you could put 20, 30, 40, 50,000, whatever, the child could afford. But for our conversation's sake, we'll just say the same 17.5. Puts it for 25 years into the life insurance instead of the 401k. And at the end of that time frame, that adult child is then age 60.
Guy, this is fantastic. So the child actually winds up with more money for retirement and it's tax-free.
Exactly. So without taxes, on the reverse legacy planning, the child actually comes out ahead. Okay, so what are the four things that we always talk about that this does that that 401ks can't do?
It grows tax-free.
Exactly.
You can access it tax-free.
Yep.
It passes to your heirs tax-free.
Yep.
And I always forget the fourth one.
Properly structured, using the right type of life insurance.
It protects it from investment losses.
Exactly.
Excellent.
Exactly. So I also want to emphasize that the child doesn't have to wait for the parent to die to access the cash value, okay? So it's there for them to use all throughout their lifetime, okay? So using the reverse legacy planning strategy, it winds up with about a 1.5 times greater after-tax benefit versus the 401k if it earns 7%, but it results in a benefit 3 times greater on an after-tax basis versus the 401k if it only earns 3.5%.
Guy, this is fantastic. Now, is there any catch to this strategy being used instead of a 401k?
Well, if there is a catch, and there is one, okay, is that the parent has to be insurable, okay? Meaning that the parent has to be able to qualify medically for the life insurance.
Okay, so what if the parent can't qualify medically for the insurance?
Well, if you have two parents, both parents are still alive, you could see about putting the policy on the other parent. Or there's something called survivorship life, which utilizes the life of both parents. So you could try that way. Now, unfortunately, if you don't have two parents and one of them is not in good health, the only alternative is to put it on yourself. Of course, the only thing about putting it on yourself is that your heirs would get the tax-free death benefit, but you would still have access to the tax-free buildup, the cash value within the insurance to use for your retirement income.
Versus the 401k.
Exactly.
So what if our viewers want to know more about this strategy?
Well, like I say, since the topics we've discussed, are specific to this particular situation, I feel sure that you would want to have your own evaluation and see how the results would come out, for your own situation. So you can, in order to do that, you can go to my website at www.guypjones.com, click on Contact Us, and I'll be glad to get in touch with you to arrange an evaluation. The other way would be to email me at guypjones@guypjones.com. Or you can just simply pick up the phone and call me at 832-677-1692. So I'm confident that if you're like my client, a tax-free retirement plan is much better than a pre-tax retirement plan not only for you, but for your heirs. So if you have any concerns about the taxes that will be due on your retirement income or the taxes on your Social Security, please contact me. I have Social Security planning software that will help you optimize your Social Security benefit. We can evaluate your tax situation and see whether or not you're paying too much in taxes that will impact your Social Security benefits. But please give me a call. My number is 832-677-1692. And again, my website is www.guypjones.com. And my email is guypjones@guypjones.com. So for now, I'd like to thank my co-host, Michael and Martin.
Thank you, Guy.
And to you viewers for tuning in today to Financial Peace of Mind, where our mission is to help you attain and sustain your financial peace of mind. Thank you and good day.